Hello and welcome to Credit Matters TV. My name is Ramki Muthukrishnan and I head the leverage finance team for US corporates. 2019 was an interesting year in that credit markets ended on a very different note from how it started. The 3 Fed rate cuts coupled with the de-escalation of trade war with China brought a wave of optimism to the credit markets by the end of the year. In the leverage finance front, 2 interesting themes emerged. One was a shift in the investor preference from leverage loans to high yields due to the change in Fed's position. And the second trend seen in the later part of the year was the bifurcation of spreads driven by credit quality and ratings. So what's in store for the leverage finance and CLO market for this year? To discuss S&P's leverage finance and CLO outlook for 2020, we have with us Bob Schulz, Sector Lead Leverage Finance, Steve Wilkinson, Sector Lead Leverage Finance, and Stephen Anderberg, Sector Lead Structured Finance. Thank you, Steve, Bob, and Steve for joining us.
Thank you.
So we've had the longest economic expansion since World War II for over 10 years, and naturally this benign credit condition has engendered loosening of credit standards evidenced by deal structure and documentation terms. So first question to you, Steve, is Steve Wilkinson. What effect has this had on the credit ratings and credit quality?
We've definitely seen an increase in credit risk over time, which we're reflecting in our ratings. On this slide, we see a comparison of our issuer ratings over time, which is a proxy for relative default risk. As of September of 2007, just before the global financial crisis, or at the very beginning, in the light blue bars, year-end 2009, just after the recession officially ended in the US, it's in the dark blue bars, and then November in the orange bars. And you can see a clear shift to the right in the bars, indicating an increase in credit risk. In particular, you see a substantial rise in the number of issuers rated single B or lower, now at nearly 60% of the market, which is up about 10% versus 2009 and 16% versus 2007. And in particular, the single B minus category has increased dramatically and is now more than 2 times the level that we saw in 2007. And this is despite the fact that the spec grade market overall has increased as a percentage of all rated issuers, so the investment grade market's getting proportionally smaller. And this really reflects an increased appetite for credit risk in the credit markets and an expansion of the rated universe. The rated universe in 2019 is about roughly 1,650 issuers, which is about 20% larger than 2007 and nearly 40% larger than 2009.
Certainly seen an expansion in the rated universe. Can you talk a little about the characteristics of these newly rated companies?
The newly rated issuers are predominantly smaller, private equity owned, and highly leveraged. We can see in this chart on the left, in the light blue bars, the number of new issuers rated each year in the spec grade category, and in the jagged blue line, the dark blue line, the percent of those issuers that are rated single B minus or lower. And you can see a fairly dramatic and steady increase in those issuers rated B minus or lower since the end of the global financial crisis. And there are a lot more single B minus ratings, as I mentioned earlier, but most of them came in and were initially rated that way. In the chart on the right, we see that more than 50% of all issuers currently rated single B minus or lower were rated that way. And of the remaining 50%, another 40% of that total were only rated 1 notch higher. So this is more an issue of the market expanding with more lowly rated credits than it is a story of downgrades necessarily.
Thanks, Steve. That's helpful. Bob, my next question is for you. There's a lot that's been written about where we are in the credit cycle. There's been a lot of reference to 7th innings. Can you help us understand what late cycle environment really is and define that for us?
Yeah, we're certainly late in the cycle. We've been saying that for a while, and we do believe we remain late in the cycle. And as Steve was mentioning, about 50% of these new issuers are B minus from the start. So when we look at the chart of the negative bias and the positive bias, so the negative bias being the proportion of ratings that are either negative outlook or credit watch negative, you can see that climbing, and you can see that the positive bias has been declining. So there's been a divergence there. So when you combine pretty good economy, but late in the cycle, which has driven a lot of these B minus issuers, you combine that with several sectors that are facing structural changes, retail, for example. It's not that surprising that the negative bias is climbing. And it's important to note that this negative bias kind of reflects our analysts' view company by company of the potential for downgrades and eventual defaults over time. We don't know when the cycle is going to end, but you can see in these shaded bars, that's the recession period, that the negative bias climbed prior to the recession. So we'd expect that probably to continue even in a relatively okay economic environment that we're thinking about for 2020.
So both you and Steve have talked about the increasing number of B- ratings and that segment of the rated universe growing, whether it's in the form of companies being rated B- off the gate, or companies that started with a higher rating and then were downgraded to a B-. Are there any sectoral nuances that we should be thinking about when it comes to B- ratings?
Sure, no, it's a good question because we don't want to paint every sector with the B- brush in the same way. So as you can see here, that what we're saying is, a big B- exposure does not necessarily equate to negative outlooks, which would then equate to the potential for a near-term downgrade to the CCC category. So technology obviously has a lot of leveraged companies, hence the disproportionate share of B-, but their share of the negative outlooks of the B- rated debt is actually is lower than most of the other sectors on the chart. And you can look at healthcare and telecom and see that their share of the negative outlooks of the B- is actually more elevated than some of the sectors, technology for example, that has higher rated or higher leveraged companies. So we recognize that CLO investors in particular are very concerned about a wave of downgrades into the CCC category, and so we would emphasize again that our analysts are looking at these companies individually, and even if there is a lot of B- in a particular sector, doesn't mean necessarily that our collective view on those companies is necessarily negative at the moment.
Thanks, Bob. Shifting gears a little, Steve, moving from credit quality onto market issuances. Can you talk a little about the leveraged finance market and what the issuance trend has been?
We've seen quite a divergence in the difference between the loan market and the high yield markets. On this slide, in the top chart, we see the leveraged loan volumes by year, and in the bottom chart, we see the high yield volumes by year. And in the top chart, we see that there's a fairly substantial decline in leveraged loan volumes in 2019, down more than 20% overall, by about $140 billion. Most of that decline happened in the institutional portion of the market, which is indicated by the light blue portion of the bars, with a much more stable performance and less decline in the pro rata market. A lot of the shortfall in the loan market was made up in the high yield market. The high yield market was up more than 60% overall in 2019, by more than $100 billion, so making up a lot of that shortfall. So on the positive side, the markets were still open to credits that could get debt when they needed it, push out maturities, replenish liquidity, et cetera. We do notice, though, in the light blue portion of the high yield bars, though, that more bonds were requiring collateral, so the market does still seem focused on credit risk.
Thanks, Steve. So let's talk about the leveraged loan market. Certainly there's been a drop in issuance, but what are the forces driving the leveraged loan market?
So one of the primary drivers of leveraged credit volume is always going to be M&A activity, bringing new money into the space. And M&A activity was down in the loan market in particular in 2019 by 38%, from a record in 2019 of $350 billion, so an all-time record. A lot of that shortfall was made up in the high yield market, however, and overall M&A volumes have been quite healthy for the past 5 or 6 years, even if they're down from the record year in 2018. One of the primary drivers of that has been high LBO activity, and this ties in with the high increase in lowly rated issuers over time. We see on this slide that purchase price multiples have been elevated at more than 10 times over the past 5 years. This requires a lot of debt to get these deals done, even with a substantial equity contribution averaging more than 40% over this time. So there's a lot of debt coming to the markets and lower rated issuers.
Bob, you talked about increase in downgrades and defaults, and certainly 2019 saw an uptick in default numbers. Can you provide some perspective on these defaults and also what our outlook for 2020 is?
Sure. So when we look at defaults, and you can see on this chart, I mean, there's an average there, 4.2%, but really defaults have either been very low or very high. And the default rate is ticking up from from a low level. In the U.S., well, our base case forecast is for 3.9%, but in the U.S., as of the end of 2019, it was about 3.1%. In each of the last three downturns, the shaded bars with recessions, it's been over 10%. So when we think it's going to be rising, that's a reflection of all the things we've been talking about. When we look at the U.S. in 2019, bankruptcies were actually the leading reason for default versus distressed exchanges, which typically have been the leading reason for default. And in fact, globally, distressed exchanges were the leading cause of defaults kind of 4 out of the last 5 years. So bankruptcies being the leading reason was a little bit unusual, and we'll have to see in 2020 if that continues to be the case. I think in the leveraged loan market, the way LCD calculates it, the default rate by amount outstanding was about 1.4%, up from about 1.3% at the end of the third quarter. So, whether it's leveraged loans or the overall default rate, we do expect that to be ticking up. I think what's going to be interesting to watch in 2020 is the mixture, bankruptcies versus distressed exchange on a specific issue.
One of the things that gets talked about in the context of default is the maturity wall and how it's pushed back. What does the maturity wall look like considering all the refinance that happened in 2019?
Yeah, companies default for many reasons, including potential maturities. But the maturity wall is certainly something important to watch. So as you can see, this is the maturity wall for debt maturities, loans and bonds, and the light blue being 2018 as of kind of mid-year, and the dark blue being 2019 as of mid-year. And you can see how it's been pushed out. When you look at the actual leveraged loan market, loan wall maturity, you have to go out to about 2026 to get a maturity wall that's higher than it was in 2018. So, and in this mix, obviously, is the various new issuers over the last few years that have maturities in these years, but notwithstanding that, the maturities themselves have been pushed out. So, we don't see in 2020 maturities being a particular driver of defaults in general, but I think past experience has shown if the risk-on nature with investors keeps up, then there could be more refinancing opportunities. About 1/3 of the leveraged loans in 2019 were used for refinancing. So,
thanks. Steve, our expectation of defaults through September of next year has gone to 3.9%. What is the view on recoveries, and how has recoveries been, and what is our expectation of where recoveries will land?
Yeah, good question. We've talked a lot about there's being increased default risk with the issuer ratings. We're also seeing the trend of increased risk in terms of a recovery perspective. On this slide, we see average recovery estimates for first lien debt over time, declining from above 70% to the mid 60% area. And for context, historical averages for first lien recoveries have been in the 75 to 80% range. So we're down quite a bit from that, and even further from a median basis where the median is closer to 100%. And there's a few drivers of this. We've seen an increase in total leverage. We've seen an increase in first lien debt leverage. We've seen more first lien only structures, and those structures that still have a junior tranche of debt to support the first lien recoveries becoming much thinner. So there's some fundamental drivers in the marketplace of increased risk that are driving our view of lower first lien recoveries.
One of the things that got talked about a lot during the course of the year was, were concerns around B- ratings lowered to a CCC, especially among CLO investors, because of the implications it would have for the payment waterfall. But at a more fundamental level, Bob, how do we think about CCC ratings, and really what purpose does a CCC rating serve? What are the characteristics of a company that has a CCC rating?
Sure. So it's a good question because it's timely, and the CCC category on one hand is just another category below the B category, but really, more importantly, it's a separate sort of set of criteria, or the way we think about companies in the CCC category. So when we think about being in the CCC category, it's a company having an unsustainable capital structure, and that could be unsustainable in the long term. It could be a more near-term concern over default risk. As you can see on the slide, there's 3 categories within CCC, and this first category, CCC+, we don't see an immediate default scenario, but we do think the company's capital structure is unsustainable. And then as you go down to CCC, it becomes more a question of envisioning a more near-term specific default scenario. So companies can be in the CCC category for longer than a year if we think that in the long term the capital structure is unsustainable. And as a company works its way towards default, they wouldn't necessarily be rated at each of these CCC levels. Could be 1, could be 2, but the main thing is we're focused on unsustainable capital structures in this CCC category.
Yeah, and the actual data on actual defaults for CCC does show that what we're signaling with our ratings is really borne out with actual defaults. So on this slide, we see the historical default rates by rating categories over a 5-year period, with CCC credits in the red bars, single B minus in the blue bars, et cetera. And you can see that the red bars indicating defaults in year 1, 2, 3, 4, and 5 for the CCC category are just dramatically different than all of the other rating categories. On average, more than 29% of all CCC credits default in year 1, and that builds to more than 50% in year 5. In contrast, single B minus just 1 notch higher, less than 8% default in year 1 on average, and you don't get to that 29% rate to year 5. So it's a very different default risk profile historically, despite the fact that it's just 1 notch away. So we are trying to communicate that with our ratings.
Thanks, Steve. Moving on to the second asset class, which is our topic for discussion today, onto CLOs. Steve, what is our outlook for CLO issuance for US, and what's really driving our view on this for 2020?
Hey, well, thank you, Ramki. We are projecting $90 billion in new issue CLO volume in the United States in 2020. This is a modest decline from the numbers we saw in 2019, which was $118 billion, but it's important to keep this in context. If you look, 2018 saw a record volume with $129 billion issued. 2019 was a little bit lower than that. 2020, we project, will be a little bit lower than that. But these are still relatively high numbers of issuance, in a historical context, given the CLO issuance looking back over the post-crisis years, even the pre-crisis years. The reason we see lower issuance, or we expect lower issuance in 2020, is number one, we expect fewer loans issued, and you need loans to make new CLOs. That's pretty fundamental. Number two, there's a challenging CLO arbitrage, right? Just the amount of money, cash generated by the loans compared to what the managers would have to pay out on the CLO liabilities isn't as compelling as it might be. So the spread between those need to be wider to really generate a lot of new issuance. And then finally, there could be less demand for floaters, just given we're finding ourselves in a flat interest rate environment. On the flip side, CLOs still offer a really compelling relative value compared to other asset classes, so that's still there. And of course, investors are still searching for yield. Looking at resets and refis, we expect about $40 billion of issuance. We break these out from new issuance because resets and refis, when you take an existing CLO transaction and you reset the spread on the liabilities, the notes. And so it doesn't add to the net supply of CLOs outstanding. You're just taking an existing CLO transaction and modifying the terms. And the way we get to $40 billion, if you look at the CLOs that are available to refinance, the ones that are outside their non-call period, which for a new issue CLO is typically 2 years, you have to look at the current spreads on the notes versus the current market spreads. And in order for them to refinance, that only makes sense if the current market spreads are tighter than the spreads on the current notes, and that's not the case for a lot of these transactions.
Thanks, Steve. Both Bob and Steve talked about the increase in B minus in the rated universe, and I think that phenomena is also manifest in the CLO universe. Can you talk about the implications for CLOs, say if a lot of these B minus were downgraded to a CCC?
Sure. Yeah, one of the things that both Steve Wilkinson and Bob spoke about was, deterioration in credit fundamentals in the loan space, and that's manifested itself within CLO collateral pools as well. And so what you're seeing on this chart here is, on the blue line, the proportion of loans within broadly syndicated CLO collateral pools that come from companies with a rating of single B minus, and then on the orange line, the proportion of loans from companies rated in the CCC range. Single B minus is of particular interest as a rating for CLO investors for a couple of reasons. One is that companies with a single B minus rating tend to see more volatility than companies even with a single B flat rating. There's a material difference. Over the course of a given year, even in a benign economic environment, a company with a single B minus rating has about a 10% chance, we've seen historically, of either being downgraded into the CCC range or defaulting over the course of a year. And then if you're looking at periods of economic stress, that can rise to 40 or even 50% of those companies seeing their ratings lowered or getting downgraded. So this is something we're definitely focusing on. In terms of the potential impact on CLO ratings, we recently published an article which explored the potential outcomes for CLO ratings under different hypothetical scenarios for these single B- rated companies. And the paper was published on November 26th. It's called To B- or Not to B-, a CLO scenario analysis in 3 acts. And it explores the outcomes for CLO ratings under 3 different hypothetical scenarios. So scenario 1 is if we take the companies rated single B- and we lower the ones on outlook negative or which have loans trading below 90. We take the single B- rating and lower them to somewhere in the CCC range. That's scenario 1. Scenario 2 is we take all of the current single B- rated companies and downgrade them to CCC. Scenario 3 is we take all of the single B- rated companies and lower the ratings into the CCC range, and we take all of the companies currently in the CCC range and assume they default with a 45% recovery on the loans. So that's pretty punitive. And you could read the article for more detail. The link is below. But basically the short answer is at the top of the CLO rating stack, the AAA and the AA notes are pretty resilient. Even under the third and most punitive scenario, you see very little rating movement, almost none in the AAA CLO ratings and very little in the AA range. But further down the CLO capital stack, if you're looking at the BB tranche, the BBB tranche, or even the single A tranche, under the more punitive scenarios, you do start to see some negative rating migration on the CLO ratings.
And that brings us to the end of this segment. Steve Anderberg, Steve Wilkinson, and Bob Schulz, thank you for your participation. And thank you all for joining this segment of Credit Matters TV.